Good afternoon. I'm Ian Novak, Vice President at First Service Residential, and thank you so much for attending our presentation, Capital Budgeting. We're going to get started in just 2 minutes. 2 minutes. Thank you so much. All right. I know we still have a few attendees signing on, but I think we're going to get started for the sake of everybody's time. My name is Ian Novak. I am Vice President at First Service Residential, and I am honored to be able to spend the next 25, 30 minutes with you discussing a subject matter that I am deeply passionate about, and that is capital budgeting. For the next 25 to 30 minutes, we will review the following agenda items. We're going to answer that all very important question of how much you should have in your community's reserve account, or how much you should be contributing to that reserve account, or how much you should be spending from that reserve account. We're going to briefly go over the most important tool of a capital budget, and that is your reserve study. We will then discuss planning for success, which is a brief overview of four funding strategies that you as a board can take back to your fellow board members or your finance committees to see which funding strategy meets your particular community's needs. We'll also talk about reforecasting with your investment plan. And finally, we'll take a look at a sample capital budget. And we will end this afternoon's presentation with a brief period of time for questions. With questions, throughout this entire presentation, you will see here under questions, you could type in your questions and I will be able to see them and answer them. I am going to reserve time at the end of this presentation to answer everybody's questions. Those questions that I'm not able to answer, we will provide answers along with a copy of this presentation to you. So I want to thank you very, very much for spending your afternoon with me about capital budgeting. When we discuss capital budgeting, I'd like to start off with a question for you attendees. We're at the latter part of 2020, and most of you with your communities have just finished approving your 2021 operating budget. So I have a question that I'm going to have a poll question open up for you guys to simply answer yes and no. And that is, have you completed your capital budget for 2021? Again, have you completed your capital budget for 2021? The majority of you have completed your 2021 operating budget, but have you completed your 2021 capital budget? So the poll is open. There should be a screen in front of you for you to click on yes or no. And we'll keep that open for another 10 seconds and see where we are as a group with completing a capital budget for 2021. Right now, we are seeing 70% of you, 71% of you have answered yes, and 29% of you have answered no. That's wonderful. For those of you who have answered yes, you will have some wonderful tools to take back with you so that you can refine those capital budgets and make sure that you do have a wonderful capital plan in place for the next 5 years. For those of you who have answered no, that's fine. The beautiful part of capital budgeting is that you can start putting together a capital budget at any time. And so you will be introduced to some tools throughout this presentation that you can bring back to your fellow board members and or finance committee members so that you can begin that process of putting together a capital budget. Capital budgeting is as important, if not more important, than your operating budget. Your operating budget that you might have just finished for the year 2021 consists of between 50 to 100 separate line items, depending on the size and needs of your individual community. And of those line items, 80% of those line items are already dictated to you. There's no decision making. They're either contracts that you've already executed dictate the cost of that line item, or for those of you who have union staff, the union dictates what the payroll, health and welfare costs for those line items are, which leaves you as a board of directors about 20% of those line items for you to contemplate on how much you would like to spend for the following year on your community. and you spend a considerable amount of time on those remaining line items. But we are finding very few boards are spending the same amount of time looking at their overall capital plan, a capital budget, which is about 5 years in length, and it consists of a cash flow report, and making those decisions of what is your plan for your community for the next 3 to 5 years. As a board member, you took on duty of care. And so capital budgeting is part of that duty of care, that you're caring for your community. And what I mean by that is caring for the property. And by caring for the property, that is having sufficient funds or at least a plan in place to achieve that. And so by the end of this presentation, you should again have some good tools to put in your toolbox so that you can care for your property in a sufficient manner. Let's begin with that all-important question that managers receive on an annual basis, at least from their board of directors, and that is how much. What I mean by how much is how much should a community have in reserves at any given point in time? Or how much should a community contribute on an annual basis? And finally, how much should a community spend from its reserves on an annual basis? And they're all very, very important questions. The answer to all these questions, however, is it all depends. It depends what you as a community would like to achieve. If I have two communities of exact similar in nature side by side, they're going to tackle their capital needs on a completely different. Their priorities are going to be different, which means their capital funding strategy is going to be different. So it really all depends. But let's put that aside for now, and let's go to what does the law state as far as how much you should have in reserves, how much you should be putting in reserves, and so on and so forth. For condominiums, we look at the ICPA, which is section 9C2, and it states that all budgets adopted by the Board of Managers shall provide for reasonable reserves for capital expenditures and deferred maintenance for repair or replacement of the common elements. So the answer to that is reasonable, and then goes on to tell you how you can go about achieving reasonable reserves. It doesn't give you really a finite answer. For those of you who are on boards of co-ops, the Business Corporation Act is actually silent on this matter. And for those board members on HOAs, the Non-for-Profit Act and SECA are also both silent on this. So what can you as a board do? You don't have finite answers to the most important questions, which is how much? Well, let's take a look at one of the most important tools that you can use by putting together when you put together your capital budget. And that is a brief overview of reserve studies. Now, I do want to preface reserve studies is a presentation on its own that could last an hour or two, because there's a lot of information involved with the reserve study. I would just like to be able to give you a quick, brief orientation of a reserve study so that you can take that back with you when you review your community's reserve study, and at least you have the basics in mind when you take a look at that. The reserve study is actually made up of two basic parts. Part one is a physical analysis. And that information about the physical status and repair replacement costs of the major common area components the community is obligated to maintain. Physical analysis really is comprised of the component inventory, condition assessment, and life and valuation estimates. And that's the physical analysis. The physical analysis is not going to change from year to year. Once a reserve specialist comes out and analyzes your community and puts down those components are not going to change unless you are adding on to your physical piece of property. So there's a lot of heavy lifting when the reserve specialist first is introduced to your property, but after that component inventory is put into place, it does not change. Let's take a look at a sample physical analysis. For this community, this physical analysis, I've highlighted one line item on their reserve study, and that is elevator cab finishes, highlighted in green. This particular reserve study was completed for this community in the year 2016. So this community on elevator cab finishes, they have six. They have six elevator cab finishes. They have a total useful life of 20 years, and what we call UL, useful life. At the time that the reserve study was completed, it has these elevator cab finishes have 9 remaining useful years of life, or RUL. The estimated first year event that the community should be looking at with the elevator cab finishes is the year 2025. 2016 cost without inflation to replace these elevator cab finishes is at $102,000. When we introduce inflation rate of 2.5% compounded on an annual basis, that cost actually increases in the year 2025 to $126,270. So this component inventory for elevator cab finishes, it tells me I have 6 of them. It tells me that they should last 20 years, but I have 9 years of remaining useful life on them. And that the year 2025 is the year that I as a board should start looking at replacing the elevator cab finishes and the cost associated with that. Now I'm going to hit pause here and tell you that the reserve study is merely a roadmap. It is not going to tell you exactly the replacement cost for that piece of component. It is a calculation. It is a best guess. To use a reserve study successfully is to say, all right, in the year 2025, I'm going to be doing elevator cab finishes. Probably in the year 2022, 2023, I want to start seeking out vendors or professionals in the elevator industry to give me some more concrete numbers so I have a better idea of overall cost. Something else to consider that reserve specialists don't put in with their replacement cost valuation. And that is, especially if you're an older building about to replace some mechanical pieces of equipment, the pieces of equipment that you are going to replace in today's environment are going to have sufficient energy savings attached to that. And you are also going to have maintenance savings to that component as well. So when you look at this cost, overall replacement cost, please consider taking into account any potential energy savings as well as maintenance savings. And then you have a true idea of what that cost is to replace that piece of equipment. So that's the physical analysis. Part 2 of the reserve study we call the financial analysis. And that merely is the evaluation and analysis of the community's reserve balance, income, and expenses. This is where you as a board or finance committee will have that very important discussion with your reserve specialist when putting together your reserve study of what is your community's funding strategy, so that that can be built into the overall financial analysis. And we're going to get into the funding strategies in just a few minutes. Let's take a quick look at a financial analysis from a reserve study. This reserve analysis, financial analysis begins in the year 2017 and goes through the year 2046, because this reserve study was done in the year 2016. The annual phased increases contributions of $66,000 per year from 2018 to 2022, and then it slows down with annual inflationary increases of 2.4% from 2023 to 2038. This particular community told its reserve specialist, we want to follow a threshold funding strategy. Don't worry, I'll define what that is in a few moments. And their threshold number was $1 million. So in the year 2038 is where we see what we call that threshold year, where their reserve account cannot go below $1 million. And so the reserve specialist built that into the overall cash flow. What we're seeing on this graph is what this board's strategy is doing. They're slowly contributing to the reserve account each and every single year, spending along the way, but really they're saving up for that big year, which is 2038, where they're doing a lot of major replacements to their particular building. If they had not contributed along the way, that board at that particular time would be looking at a major issue to resolve. How are we going to do all this needed work to keep our property values consistent without any associated funds? So a special assessment, getting a loan, or raising assessments. This community, by consistently contributing to the reserve account, the future owners of this particular property will have sufficient funds to take care of those extravagant capital needs. Planning for success, and this is where we get into the funding strategies. There are 4 basic funding strategies that you as a board can be looking at. And I'm going to go from one extreme of a funding strategy to another. First one is called full funding. And that really is what it means, fully funded. The goal of this funding strategy is to maintain the reserves at or near 100% as called for on the component inventory. So if the reserve study states that you need $1 million, you're gonna have $1 million. Or to be, for the example I'm giving here, of a component with a 10-year life and a 10,000 replacement cost, it should have 3,000 set aside for its replacement after 3 years. In this case, 3,000 equals full funding. You're putting a portion of that replacement cost into the reserves each and every single year. There's a pro to this. All reported projects will be fully funded. It's the easy method. You follow what the reserve study tells you, and you make sure that you have that amount of contributions into your reserve account. But there's a con to this approach, and that is if you're not careful, you could be overfunded. Overfunded because you're actually maintaining those components really, really well, and it doesn't need replaced in 9 years. It probably needs replaced in another 15 years. But you have assessed your owners for that reserve contribution to be fully funded. And so some owners could see themselves being assessed in excess, and you're overfunding that reserve account. The next funding strategy on the other end of the stick is what we call statutory funding. That is the bare minimum. The bare minimum that you as a board should set aside to the reserves is required by local statutes. Well, we all looked at the local statute for condominiums, which is reasonable, and for HOAs and co-ops, those statutes are absolutely silent on the matter. There is one statute, quote unquote statute, that all communities could be looking at in the state of Illinois, and that is if your community, prospect buyers would like to buy into your particular community and they don't have cash, they're going to seek out a loan in order to purchase that piece of property, that lender is going to receive a copy of your budget. And they're going to look at one line item only, really, and that is the contribution to reserves. And they're going to see if at least 10% of the assessments are being contributed to the reserve account. So that's pretty much a statute that all communities should at least be abiding by, and that is 10% of your assessments should be going into your reserve account. And that way, those prospect buyers can easily get a loan in order to purchase that unit or that piece of property in your community. The risk to this approach, of course, is a high risk of special assessment. There's no plan in place. You're just merely putting money aside into a reserve account to meet local statutes. The third one is called baseline funding. And the third and fourth strategies that I'm going to speak about are the 2 strategies that the majority of communities abide by. Baseline funding states that the goal is to keep the reserve cash balance above 0. And you're reading that right, above 0. So that financial analysis screen that I showed you just a few minutes ago, where they were under threshold of having at least $1 million in the account. If they were using baseline funding, instead of having $1 million in the year 2038, they would have $0. So that means that while each individual component may not be fully funded, the reserve balance does not drop below zero during the projected period of the reserve study. And a reserve study is usually between 15 to 30 years. The pro to this approach is less risk of overfunding. You're assessing your owners the right amount. You're not over-assessing, and you're not having too much being put aside into that reserve account. The con, and it's a major con, is that a minor reduction in a component's remaining useful life or an increase in costs can result in a deficit in the reserve cash balance. Or if I were to really define that, if life throws your community a curveball and you don't have enough cash in the account, well, then you're going to have to make up for that shortfall. Finally, if you are going to use this approach, annual reserve updates are highly recommended, which is an increase in operational cost of having that reserve specialist come out to your community on an annual basis. That way you can really rely on that reserve study. The fourth and final funding strategy is what we call threshold funding, which we saw an example of a few moments ago. It's based on the baseline method, but the goal is to keep the reserve balance above a predetermined dollar amount. It could be any dollar amount that you see fit for your particular community. There is no number that you need to abide by. It could be $1 million, 500,000, 50,000. It's a number that fits the needs for your community. The pro to this is less risk of overfunding, like the baseline methodology, and it's a more conservative approach to the baseline funding method. The con, and there's really only one, is that more frequent reserve study updates are recommended, which leads to a question: when should I be having that reserve specialist come out to update my reserve study? Standard practice is every 3 to 5 years, and that's standard, every 3 to 5 years. If you're going to be using the baseline method of funding strategy, it should be done on an annual basis. Threshold funding, use every 3 to 5 years, unless you're doing a lot of major work in a particular year. Advice is to have that reserve specialist come out after that work is completed to review and to update your reserve study. So those are the 4 major components of funding strategy. Forecasting methodology. Number 1, make sure, as we talked about, update your reserve study on either an annual or every 3 to 5 year basis, and follow the plan. It's nice to have a reserve study, but you need to use it. It's a very important tool in order to put your capital plan together. 2, have your money market and investments analyzed. Now, granted, in today's market, the rates are very, very low, but hopefully soon we'll be seeing those rates go up, and that you will have more choices. And you should be analyzing those choices on a consistent basis. One of the beauties of a FirstService Residential is that we do have a financial arm that will be able to do that analysis for you so that you have options for you to choose from. And finally, the third part is called reserve budget shortfalls. You are going to have life throwing you some curveballs. You can have the most perfect plan in place, but that curveball is going to throw you an issue, a shortfall that you're going to need to take care of. So let's talk about that for a second. The knee-jerk reaction to a shortfall, of course, is special assessment. And it's what most boards react with, which is a special assessment. But I want to take a moment and advise you that a special assessment, yes, is needed, but isn't your full-on answer to that particular issue. Along with a special assessment, you could be looking at what we call a blended approach, and that is look at increasing your contribution to your reserve account as well, which would mean a slight increase in assessments to take care of that. And finally, because rates are still very, very low at banking institutions, look at the possibility of either getting a line of credit or a particular loan to take care of that capital project. We have found that board of directors looking at this blended approach and being proactive with their community of how they're going to solve this problem are more successful in getting buy-in from their community than if they go to the community and saying, we are taking care of the issue with a full-on 100% special assessment. The board is taking everybody's needs in mind, and you will have a higher success rate of buy-in from your community by looking at this blended approach. I do need to, on the loan aspect, again, First Service Financial, an arm of First Service Residential, will be able to assist you in looking at those options for loans or line of credits from banking institutions locally and across the nation. Let's finish this section by just taking a look at a sample of a capital budget. It's very simplistic that I put together for this particular community. And it's called a capital budget, but in essence, it's a cash flow report. It begins with a beginning balance taken straight from the bank statement of this community's reserve account, dated December 31st, 2019, and they had a balance of $200,000. That's where I'm going to start off for the year 2020. I'm then going to put my budgeted annual contribution amount that I'm going to put into the reserves in the year 2020 of $51,500. I'm then going to use my reserve study and report all the expenditures. And for this year, it was a boiler project in the amount of $30,000, which ends my ending balance for the year 2020 at $221,500. Bring that number back up to my beginning balance of 2021, and so on and so forth. On the expenditure side, you want to place all your projects as listed in your reserve study into this cash flow report, but you also want to put in those other projects, those special projects that you as a board or your committees, or most importantly, your community feel is very, very important that you need to take care of. Put all of that into this capital budget and take a look at what it does to your overall cash flow. Does it meet your overall funding strategy? Where are the shortfalls? Do you need to make decisions on your overall cash flow plan so that you don't have those shortfalls? Or do you need to be looking at a blended approach at that particular year in order to take care of that shortfall? What I love about this capital budget, which is I'm looking at just the next 5 years, that's really all you as a board member should be looking at. Anything past 5 years, it's just a little bit too much information. The next 5 years is ample enough for you as a board member or a committee member for you to be making decisions on. For this particular community, an elevator project is in line for the year 2024, an approximate cost of $150,000. Well, let's pretend that your community is banging on your door saying the elevators, we know the reserve study says it shouldn't be looked at until the year 2024, but we want it done sooner rather than later. We feel that by doing the elevator project sooner rather than later, it'll keep our property values stable. Okay, well now you can have an adult conversation with your community. You've heard the request from your community, and you're going to move that $150,000 expenditure into a year of either 2021 or 2022 and see the result of that move to your cash flow report. By doing that, does it meet your overall funding strategy, or does it cause a shortfall? If it causes a shortfall, then you can report that to your overall community. We can do the elevators, but it's going to require either a special assessment or maybe a special and raise of assessments, or we need to go get a loan. Is it still that important to the community that we get the elevators done before we have enough cash to do it in 2024? And now you're having a nice, serious conversation with your community rather than having a knee-jerk conversation of an issue that has just arisen. And that's why I really like seeing boards having a capital budget put in place for the next 3 to 5 years. That concludes the presentation, but I do want to end with a few takeaways of some topics that we did touch upon this afternoon. Please review your capital budget at least on an annual basis and plan for the next 5 years. Smaller communities, 3 to 5 years. Perform preventative maintenance as recommended to prolong your component's useful life and delay costly capital improvements. By keeping up with that preventative maintenance, you could be saving money in the long run of keeping that component in use for another 3 to 5 years rather than having to replace it. Use an up-to-date reserve study as a planning and budgeting tool for your capital improvement projects. And finally, fully fund your reserves. And what I mean by fully fund your reserves, follow your funding strategy, whether it is 100% fully funding, statutory funding, baseline funding, or threshold funding. Follow the plan. Gain community support by being transparent and inviting resident feedback. Share your plan. Share the capital budget with your community when you share the operating budget with the community. Have a special finance committee meeting. If you don't have a commission or a committee, form one. They will be best aligned with your overall community so that the community feels that they are being heard, which is just a win-win for a community and the board of directors overseeing that community. And finally, it goes without saying, work with a property management company that has the expertise and resources to help you fund and plan your capital improvement projects. We do have First Service Financial, First Service Energy, and First Service Project Management at your disposal. And you can find out more by reaching out to your property manager or your regional director for those additional services. And this time, I'd just like to open it up for any questions, and I'll answer as many as I can. What's the difference in a capital budget and a reserve study? It's a very good question. So a reserve study is a study of the physical components of your property and what that replacement cost is for that particular component. And all the components put together within that report is called a reserve study. A capital budget is using that reserve study and building out a 5-year plan of how you're going to spend the reserve funds on your particular property. So it's a cash flow report and it's a plan using the reserve study as a tool to put that plan together. Has this presentation been recorded so that we can share with the rest of our board? Yes, this is being recorded and will be shared to all attendees along with the PowerPoint presentation that I shared with you. Are you available or somebody at First Service available to put together a capital spending plan together? By all means, yes. Please reach out to your property manager, your regional director. We have our accounting department to assist you with this. And more importantly, we do have our financial arm, First Service Financial, to look at your investment component that will feed into your overall plan. And I'll just take a couple of more questions. It's a very good question, and I don't have a straight answer for you, but I want to share this particular question. How should historical cost be incorporated in your capital budget? It's a very, very good question, and I'm going to look for an answer for that question and share it with the attendees. Thank you very much for that question. And I'm going to look for one more question. What about setting a contingency CapEx budget? How much should be set aside annually? It's a very good question. And I have had boards add a line item to their capital budget called contingency. And that's for those communities that really have a very tight capital budget plan in place. They're not fully funded, they're baseline funded, And so if they do have a catastrophe, life has thrown them a curveball, they don't have money set aside to take care of that. So those communities have taken care of that by adding an expense line item called contingency. And what that amount is, it really depends on your particular community, of how much more assessments you want to assess your community on that. There is no really rule to abide by of how much that contingency should be. I would also look at the last 4 or 5 years of historical value, of cost valuation of how many curveballs have been thrown at you because of deferred maintenance on particular components. And do you want, while you're saving up for an overall a replacement of that deferred component, how much should you set aside on contingency for minor replacement before the major replacement takes place? I'm sorry if I couldn't answer all of your wonderful questions. We will provide answers to the majority of these. We will provide a recording of this, and we will provide the actual PowerPoint presentation for you to take back to your boards and finance committees. Thank you so much for joining me this afternoon. Really do appreciate it. And I wish all of you a very safe and happy holiday season. Take care. Bye-bye.